Smart Money Nation, welcome back to the channel. Listen, I wanted to do a quick part 2 to the life insurance video that I just dropped yesterday. I wanted to give you guys an update and give you a quick breakdown of why I said what I said, and some numbers behind it and just some references. All right, so we're going to get into that today. As always, if you're not subscribed to the channel, make sure you hit the red subscribe button, like, comment, share my videos, share it with somebody that you value. And if you haven't checked out the first video, just go to the playlist section on my channel and hit the life insurance for entrepreneurs. You'll find the first video there. I might put it on the end screen, but with that being said, let's go ahead and get started. Hey. Hey. All right, we're here on guardianlife.com, kind of giving us a breakdown. I might put the link to this in the description below, but it's giving us a breakdown of term versus whole life. And the reason I'm doing this is because I want to kind of get rid of the misconception that whole life is the only way to go when you're trying to get life insurance. It might not make sense for you at the time of where you at right now, right? So, and that's what I want to kind of address, is that you have to take a look at where you are in your life, and that might dictate whether whole life is right for you or term is for you. Like I said in the last video, currently where I'm at, whole life does not make sense. So let's talk about it. Initial cost. Term life is much lower, much lower than whole life. Whole life is 6 to 10 times more expensive than term, right? And we'll go into what the cost is, like the estimated cost and stuff like that. Now, it does have some of its advantages as well. The reason they call it whole life and term is because permanent coverage, right? So term is for a certain term, right? So you can do a 10-year term, you can do 20 years, 30 years, and so on. But after that 10 years over, you don't get to like renew. You can renew it, but it's going to be at a new premium amount, right? So if you're older, of course, it's going to cost you a lot more than it cost you when you were 28 to get term life insurance, where with whole life, it's for your whole life, right? But you got to keep up the payments pretty much the rest as long as you're living. So that's the two differences, and you could see that in the actual names, is the length of coverage. So, but like I said, you can get a term life insurance for up to 30 years. I don't know if anybody does it for more. As you can see right here, 10 to 30 years. Exam, of course, depending on how much life insurance you're getting. In both cases, it might be required. Like I told you with mine, an exam was required. And that was because I was doing $1 million. So when I looked into $250,000, there was no health exam required. So the key thing is the cash value, right? So there's no cash value. You don't get any money back. You can't borrow against your term life insurance. With whole life, you can borrow against the savings side of it, right? So when you're paying your premium, let's just say your premium is $500, they'll have $300 go towards the actual premium, $200 towards like the cash value, the cash side of the whole life insurance, right? And that accumulates over time. But that takes a long time before it is a significant amount that you would borrow against and all that, right? So that's the significant benefit to it. And they also invest that, right? So the investment gets you back a small return, right? I don't know what that return could be depending on what they invested in. The return could be low, could be high, but you also do pay a lot of fees. And by that time, after all them fees and stuff is taken out, it's not significant either, right? So these are things they're not going to tell you about it. Now, let's see. Okay, so that's like the simple breakdown between two of them. Right, so the main thing right now, what is the actual, let's go into what the actual costs are, right? So here, whole life, monthly quotes, and this is not what you will pay exactly, because they don't, nobody knows who you are right now. They don't know. So it's like an estimate of what you would be paying monthly, around $360 a month, and around $4,300 a year, right? Here, This is nerdwallet.com, by the way. Here, premiums are expensive. They talk about the drawbacks of whole life insurance as an investment. Premiums are expensive. You're looking at an annual premium of $6,300 for a $500,000 policy. For women, it's a little less. As far as compared to term life insurance, you're looking at $340 annually, like a year for a term, right? So 340 versus 6,300, that's a lot. That's a whole lot more that you're paying for the same death benefit, right? So now, what are you getting that's so special that you're not getting with the term life insurance that you should be paying an extra $6,000 a year for, right? Which is the cash account that you get with it, right? That you can borrow money from. It's tax free. Is that worth it? That's the thing that you got to kind of figure out right now. Is it worth the extra $6,000 a year that you're paying? Can you take $6,000 a year and do something else with it that's gonna be more valuable to you? That's gonna yield you more profit. That's gonna accelerate you from where you are currently, your current position, right? To me, that's a no-brainer. I can. So I'd rather have the $6,000 to invest in myself, to bet on myself, than save it in this little account where it's growing. And you're not, granted, you're not seeing this whole 6,000 in your like cash account of the whole life. You're seeing a portion of it, right? So it's not even the 6,000. So that's the pretty much the $1 million question that you got to ask yourself and you got to answer. So let's go over a little bit more. The cash value is slow to grow. So your first few years, your insurer will direct a chunk of your premiums to fees, commissions, and other administrative costs. Eventually, a higher percentage of your premium will go towards your cash value, but this takes a while, so it could take 10 to 15 years. So 10 to 15 years of paying $6,000, let's just say $6,000 a year, right? That's you've already paid $60,000 to $90,000 before you can have a significant amount in your cash value of your whole life insurance, right? That's crazy to me, at least where I'm at right now. So that's one drawback, but they don't talk about that, right? The returns can be low. The average annual rate return on a cash value for whole life insurance is 1% to 3.5%. So that means for every $100 you have in there, they'll get you a return of $1 to $3.50. I know personally I can do better than that. So why would I take my money and put it into this account where you're getting me back 1% to 3.5%? And you'll hear you're gonna get guaranteed 6%, 7%. Within this, you'll hear that places. I've heard it. I remember hearing this in multiple people trying to sell whole life. But they don't tell you about the fees. All the fees that got to be taken out that knocks it down to 3.5 to 1%, right? So that's another part of it that you got to take into account. You can't control your portfolio, so that means you cannot decide where they're going to invest that money that you're saving. So the money that you're putting in there, you have no say-so on where it's going. They can put it in anywhere they please. It doesn't matter. You have no control of that. So that's another drawback to it. Tax implications if you draw cash from your policy. So this is pretty new to me. Generally, you only pay taxes on the cash value if you access it. And the IRS only charges a tax on the amount that exceeds the policy basis, the amount of money you've already paid in premiums minus any dividends you've received. If you draw less money than the policy basis, those funds are yours, tax-free, but any withdrawals over that are subject to income tax. Okay, so basically any amount that you withdraw over what you've already saved, I think that's what I'm getting from it. But anyway, so these are things that you want to take into account before jumping into deciding whole life is the only way to go. And I'm saying this because I was there for a few months. Like, okay, I don't even want to get life insurance until I can afford to pay $6,000 a year premium on just the life insurance, and whole life is the only way to go. And they kind of messed up my head on that. So I'm giving you guys the research I've done to hopefully steer you guys in the right direction when it comes to this, because life insurance is really important, and you know, it's something that you want to make a decision on sooner than later. We never know what's going to happen tomorrow. But I don't want you to sit back and feel like, hey, I have to get whole life. That's the only way, because somebody is being a clown and telling you that's the only way to go because you can borrow from it. You could be the bank and all that crazy things. But and another thing, right? Interesting thing. I made this huge. I'm gonna lower it a little bit. Commissions, all right? So this is the people that's telling you whole life is the only way to go, and why they're telling you that. Commissions vary by policy and company, and they're talking about for people that sell insurance. But life insurance agents often receive 80% to 100% of the first year's policy premium as a commission. So that means whatever you're paying for the first year, 80 to 100% of that is going to the life insurance agent that's selling you the actual policy, right? So who does it benefit more? Like what benefits them more? Selling you a policy that you're paying $6,300 that first year, or you're paying $340, right? So I don't listen to, I don't want to say that, right? But just do your research. This is the research, right? And I now understand why they push whole life down your throat is really because they walk away with $6,300 rather than $340. Not because it makes sense for you where you are at in your point in your life at this point. So I hope that helped. My sources: NerdWallet.com, Forbes, NerdWallet, and Guardian Life. These are where I've pulled up everything that I pulled up today in this video to kind of give you guys a nice breakdown of why I said what I said in the first part of this life insurance video. Anyway, I hope that was helpful. As always, I appreciate you guys supporting. I appreciate you guys watching. Please hit the subscribe button if you haven't subscribed. If you haven't checked out the first video of this segment, this life insurance for entrepreneurs segment, make sure you go to the playlist and click the first video. I'll probably leave it in one of these boxes that pop up at the end. But yeah, I appreciate you guys. I'll see you guys in the next video. Peace.
Hey.